All right, so it's January 5, and imagine your financial app sends you a message that you're on the best financial track ever. Do you believe it? Probably not, because, New Year's resolutions are always broken, right? So today we're going to talk about 10 resolutions that you can set that I think you can probably keep by year end and make your financial life better.
Welcome to a Wiser Retirement Podcast, where we cut through the noise and bring you real, honest conversations about investing, retirement, and building lasting wealth. No sales pitches, no gimmicks, just everything your financial advisor won't tell you.
I'm Casey Smith. Today I'm joined with our senior financial advisor, Shauna Theriault, and today we're discussing 10 financial resolutions to kick off the new year right. Hey, Shauna.
Hello.
So 10 resolutions. We've ordered them from what I think is the easiest to the longest term payoff.
Okay.
You think they're more random, I think, but
I think they're more in order of where you should start, but
okay.
I don't know because
We'll let people, the listeners will decide.
Okay.
But yeah, I've always thought about bringing in a fitness guru this time of year to talk about how to create an exercise plan that you can actually keep to, or how to keep those habits, I think you do it for 30 days or something. I think you do something for 30 days and it becomes routine.
Yes, it does. It's and to ingrain it in you, it's 66 days, I think is what they
66
say.
days.
Yeah. I don't know that you have to do it every day, but
yeah.
The best thing I can say is do something you enjoy doing. If you hate running, don't run.
Yeah.
If you try something new. If you like yoga, do that. If you like whatever you like to do what you like to do, or else it's not going to be sustainable.
Drink whiskey for breakfast.
With
no,
that
that's
doesn't
not a thing.
That's not a thing.
Your hand goes up and down.
That's true. It's really good workout for your arm. Not good for your metabolic.
Drink whiskey for breakfast. Don't worry about that. You don't have to worry about me. I'm fine.
You don't even drink that much.
I don't really.
No. You're making that sound bad.
I know I am making that sound bad.
You don't even drink like that.
No, I don't. I have all this whiskey in my office though. If anybody,
it's been there for 10 years or something.
It's aged.
You try to give it away.
It's aged. Yes. Well, that's the whole part is you have a bottle of whiskey that I probably bought for an occasion, but never opened it.
Right.
And, but you don't want to look at your client and go, hey, do you drink whiskey? Because a lot of times, because it can go multiple ways. It can go, they're a Scotch person, and that's oh, I don't drink whiskey. I drink Scotch. And it's you're a whiskey person. I thought we liked each other.
I'm sure you wouldn't be judged for that.
Or we're still in the Bible Bells. Yeah, I don't drink at all. Know. So you just have to. I don't know. So yeah, there's lots of bottles in my office that are all very good.
It's not because you drink a lot; it's because you don't drink a lot.
Well, no, it's because my best friend, he has these whiskey nights, and you have to bring a bottle of whiskey. So I'd bring a bottle of whiskey, and then what do you do with it? Because, and then having teenagers at home, I just don't want.
Yeah,
I don't want alcohol in my house.
Yeah,
so it all just gets stored here. But yeah, man, if you're a whiskey drinker, next time you pass through the office, let's talk.
Yeah, absolutely.
Let's talk. I've learned a lot more over the years just by being around people who are really into the different types of whiskey.
Yeah.
So anyway, this is not a whiskey podcast.
No,
we did that already.
I don't even drink.
That's right. You don't even drink.
I don't drink at all.
You can go back to
I know nothing about
November. You go back to November, and you can get our whiskey. Listen to our whiskey episode if you're still trying to gift whiskey.
But a lot of people do dry January, so maybe that's not a good episode to listen to,
yeah,
right?
Maybe not.
Dry January.
Let's
a lot of people, this is really fun, do dry January, and then they just keep going because they realize they don't really need it. So that's awesome too. Yeah. I have a lot of friends that have done that. I hang out with a lot of non-drinkers now. So
that's probably good.
It's good. It's very good. It's better for your body.
Yeah. You shouldn't drink because it's trying to pacify something.
No. But
anyway, I'm pretty good at a couple of things. And so my whole thing is I jump in with both feet. I'm all in.
Yeah.
So I feel like if I really got into whiskey, I'd just be walking around drunk all the time.
No, that's not good. Why don't you jump all into exercise and working out?
Yes,
then that would be the good part.
I should jump all into that. Instead, I just jump all into building the best wealth management firm.
Well, I mean, that's a good thing too.
So that's nothing wrong already with occupies 70 hours a week. So I don't have room for anything else.
Well, that's not a bad thing either.
All right, let's get back to the topic. 10 resolutions. Let's start with number 1. we should always start with number one.
Doing a 30-minute money reset.
30-minute money reset. So here's your challenge. Can you do it in 30 minutes? So I think the point here is awareness.
Yeah. And just looking at.
So a lot of times people just aren't aware of what's happening. They think they've convinced themselves that everything's okay. Everything's fine. I mean, I don't have cash flow problems or anything like that.
Yeah.
And they just go about their life. But if you sit down for 30 minutes and you write down what your assets are, what your liabilities are, what the minimum payments are, what the interest rate is, and then you look at your income and then your expenses, your living expenses, do you have excess every month? Are you at a deficit?
Right.
Do you need to shift some things around to make some big changes?
Yeah.
These are all things that a 30-minute back of the napkin reset could get you, right?
Yeah. I mean, anytime you're starting something, taking an honest look at where it is and starting there is always the best place to start.
So once you know where you are, you now know how to make changes.
Right.
So I don't know if that's really a resolution. I think that should be a monthly thing, honestly. If anything, quarterly, but you should understand what's happening in your finances and how can you make changes.
Yeah, absolutely. And where you are, for sure.
Number 2,
setting one clear money goal.
So we have many podcasts on setting SMART goals and the acronym for that. I don't know if we want to dive into that today, but
Michaela and I actually did that at year end.
Oh, that's right.
We did the SMART setting goals and all of that.
So you want to make sure that you write a goal down, you create a deadline, you create a target. So if it's very vague, like I want to be better with money this year, well, that is not a goal. That's just a vague statement.
Yeah.
I want to eliminate $6,000 of my credit card debt by March.
Yeah.
That's very specific.
Yeah.
And it has a deadline.
Yeah. So that way you can judge it and make sure you're getting there.
And I think it's important you set one goal. You know how many times I've met with people that are trying to get out of debt for various reasons, and they're like, "Well, we send an extra $25 to this one, and we send an extra $50 to this one, extra $100 to this one, and we send an extra $200 to the mortgage." I'm like, you're just spreading dollars around everywhere. Let's rein that in and let's pick one thing that we want to pay off as soon as possible. And let's take all of our extra and apply it to that.
Yeah.
And you're gonna feel like you're moving somewhere.
Right.
Versus just randomness.
Right.
You know?
Right.
Same way goes for savings.
Yeah.
Oh, I put an extra $100 in this account, and then I put an extra $100 in this other Roth, and I put it's just focus on one thing.
Right.
Max out your 401k.
Right.
Right.
Right. Absolutely.
Okay. Number 3.
Automating savings. So, obviously deferring to your 401k. If you're saving to a brokerage account. So if you have that excess and you realize you have that excess every month after, putting money towards your 401k, maybe looking at, education savings 529s. But if you have that excess, then putting it automatically into a brokerage account or a savings account if you're saving up for something. So moving it out of the checking where it inflows and outflows. So that way you can either invest it or save it, and automate that process so that it's not there at your disposal.
That's right.
And then it's working for you. So you can do automatic movements, but you can also do automatic purchases just like in your 401k.
Make it disappear before you actually get it.
Right.
And
it's always a good rule to pay yourself first,
Yep. Now we're getting into more budgeting things. Number 4.
Tracking your spending for 30 days. Maybe even a quarter, because there's some that are quarterly payments.
Yeah.
But definitely tracking your spending, because I feel like, a lot of times we ask clients, it's like either one or the other. When clients come in, it's like, what do you spend? And they're like, hold on. And they pull out their spreadsheet and it's like
their 10-page spreadsheet.
Right. And that's awesome though. That's awesome. But then the other ones are like, I don't really know. What can I spend? Give me a budget, And so it's kind of, I don't know.
Goes both ways.
I would say it's probably 60-40. I'd say 40% or maybe even 30% have it like right there. And then the other really don't know.
Most banks now have built-in money tracking apps. It's free. It's already set up.
Yeah.
And you can categorize everything. Grace here, one of our planning associates, she likes Money Penny. It's an app in the App Store. So you can add that to your account. I think if you pay a little extra, it'll automatically categorize things. But the free app, you can categorize
I
things
use
manually.
Rocket Money.
Okay, yeah,
And
I've
it
actually heard of
downloads that and it tells you, it categorizes it automatically. And if something doesn't have a category, it doesn't know what to do, it like alerts you. It's
Yeah.
actually really good.
That's awesome. Good.
It's actually really good. And
Probably
it
should have a
sends
whole
you,
episode on that, honestly, about different money apps.
yeah, it's really good. And it tells you, do you want to save money on your bills, or like a bill went up this month? Like, how you always renegotiate like your cable bill or whatever. Yeah. It tells you if it goes up, like maybe you need to renegotiate. It'll actually negotiate for you too. I haven't tried that, but yeah, I don't know. It's really
Rocket Money for the win.
Yeah, I don't know. I've liked it.
I would also say if you decide to keep a budget, that I would keep it, the category is very broad. Like you don't need to say, I spent X amount of dollars on socks and my sock allowance is X. Unless that's your hobby, and that's weird. But yeah, so I would, household expenses.
Yeah. Yeah.
Food or groceries and dining out. Just
I would completely say that, unless you just feel like there's this black hole of household expenses and you're in the red every month, then maybe dig in a little bit.
Yeah.
If you need to find, if at the beginning you take that honest look and you're running a deficit, then that's where you really need to drill in and say, okay, where can I cut?
Yeah.
Also, where can I trim? So that way we're not, running a deficit's bad.
And then once you set the budget, then that should take care of itself,
right?
Because you wouldn't have to be as granular because you just know what the max category is.
Exactly.
But if you're investigating, sure, then maybe dig it out a little deeper.
Absolutely.
Speaking of budgets, number 5, create a fun, guilt-free budget.
Yeah.
So this is where a long time ago in my house, I would say, hey, we're off budget. And then there would be a big, big argument. And I got tired of fighting about it. So I just got kind of tired of talking about money in general. And so finally one day I said, I don't want to fight about anything, but I need you to answer one question for me. What does budget mean to you? And budget meant we have to take the kids out of private school, can't travel, can't get our nails done, can't do anything fun. We just sit at home and stare at each other. And I said, wow, that's interesting because I believe that budget means every dollar has a purpose. Two very different, because people say I'm on a budget and they'd say it hopefully they say it with hope, but a lot of people say it in a negative context, right? So I think that
I think everybody's on a budget, whether it's a good budget or a bad budget. You have a spending habit, right? Whether it's positive or negative.
Right. So that's my point. My point is that your budget is every dollar has a purpose, and maybe there's a category for a dollar that means nothing. This category over here is fun. We spend it on whatever we want to spend on, right?
Yeah.
So just have make sure every dollar has a purpose, and you have a budget that makes sense. No one wants to live like a pauper.
Yeah.
Now some people do. We know those people. But if you want to go and stop and get Chick-fil-A, you should be able to do it guilt-free because it's in your budget.
Right.
Right. This is what we do. This is our lifestyle. Right. Some people want to drive nicer cars than others. It's built into the lifestyle. Right.
Yeah.
But you make sure you can afford that lifestyle.
Right.
That's a big thing. Okay. So number 6,
building or rebuilding an emergency fund.
Yeah. So this prevents from having to go back to a few steps ago and add up all your credit card debt.
Mm-hmm.
So you need to have a reserve fund available so you don't have to live on credit cards.
Right. Right. And if you dig yourself out of that, then have that emergency fund set aside. Usually
I think that's a great resolution for families, is to make sure they have 6 months of their expenses.
Absolutely. 3 to 6 months, and just starting with $1,000 and then paying off debt, and then, then starting to build that 3 to 6 months. So that way you just have that reserve there.
Yeah. And that's important. And it doesn't need to be invested in anything. Your reserve is not your brokerage account.
No.
Your reserve needs to be cash, earning hopefully 3 to 3.5% in
the high yield savings. So you can, checking accounts typically don't have that. You can do like a money market or a high yield savings. There's, tons of different banks that have high yield savings that you don't have to buy into in CDs and have it locked in.
Correct.
Yeah.
Speaking of debt, what if we need to get rid of high interest debt? So that's number 7.
Yeah.
So you think about how much, if you added up how much you spend in interest every year.
Yeah.
On high interest credit card debt, that's enough to scare you to death.
It is scary.
Even with mortgages at 2.5%, 3.5%, the ones that have obviously been taken out, not the current ones. when you look up on a 30-year mortgage, how much interest you paid over 30 years, it's like a whole nother house. It's crazy.
Yeah.
And it's 10 times worse with credit cards.
Yeah, we have a spreadsheet on our website that can help with that. But, it depends on what motivates you more. I mean, honestly, taking that honest look and then seeing, what excess can I put, and then attacking one card at a time. You can start with the lowest balance first so that you feel like you have more wins, paying things off. But, from a financial standpoint, it may make more sense if you don't need that win feeling for that, instantaneous, to pay the highest interest rates first.
Yeah.
And just tackle that.
Yeah. So there's two. It's called avalanche and snowball method. So avalanche is you pay the highest interest first. Snowball is the smallest. I like the snowball because you get something small, it's paid off. You get a quick win. And that win is dopamine, right?
Yeah.
Like, I won.
Yeah.
So you feel like a winner. You go get the next one, to the next one, to the next one.
I don't know. It'd bother me if I had a really high one and I was paying one that was zero, though. Because it's like some people have zero and some people have a high one. And I'm like, I don't know.
That's true. Bottom line, come up with a strategy, set a goal, eliminate it.
Yeah.
Once you do that and you're out from underneath those payments,
don't get into it again.
Don't get into it again. But more importantly, you can start building wealth. You can't build wealth if you're spending everything on interest payments.
No. It's a bad cycle.
Number 8.
Increasing your retirement contributions.
All right. So we're out of debt. We have emergency reserve fund. I see what you mean now. This is good.
I feel like it is. It's like budgeting and then emergency. That's what I felt like.
So we want to increase our retirement contributions. So ideally, yes, you want to be maxing out your 401k plan at a minimum.
Yeah.
And for younger people, that's going to be harder to do.
Yeah.
For people who have more, I would say, hey, maybe you should be not only maxing out your 401k, but let's put money into a brokerage account, save in addition to that. But if you could just raise it by 1%, well, if you just did 1% a year, imagine if you were like, 28, 30 years old, and you just raise it by 1% a year until you max it out in the future.
Yeah.
Like how powerful that would be.
Very powerful. The earlier you can start, the better, just because the power of compounding, of course, that. But I don't know. I've seen a shift though. It's like, I don't know if it's a shift, but I've seen, younger couples come in and they're like, well, I want to enjoy my money now though. And it's so hard for them to forecast. The older we get, the more we're like, oh, we really need to, really start contributing there, but also increasing the contributions. But it's also hard when you first get out of school. Maybe you have student loan debt or you're new in your career. And so then you're trying to buy a house maybe at the same time. And, then maybe you start a family. It's like all those expenses at once come when your income you're not at your highest earning years, Right. So it feels hard. It feels like it's so far in the future, but it also feels financially hard where you really have to budget in those early years. And later years, maybe you don't have to budget as much because you did early on.
Yeah.
But I can tell you, catching up is much harder.
Oh yeah.
Making up ground later
because you don't have any compounding.
Right.
Left.
It is much harder, and you have less options in the future. So it's like, yes, do have that fun budgeting built in. But, your future self needs your current self right now to be disciplined so that your future self you have more options in the future.
Yeah.
So, and it's hard to see that when you're in your 20s, I think.
When I'm reviewing planning notes in our team meetings on Mondays, I noticed one this past week that said they wanted to know if now was the right time to be planning for retirement. And they were like 48 years old. And I'm like, wow, 48, you should have started 10 years ago.
Right.
But that's often what happens. Like, I want to retire. Am I ready to retire? And they're 62 years old when they come in for the first time.
Yeah.
If they'd been in 20 years prior, think of how much more money they would have.
Yeah. If they would have had some guidance and
absolutely.
And then you have the flip
sometimes
side.
it's just dumb luck. They were good savers and it kind of worked out.
Yeah.
Right.
Yeah.
But there was no real plan put in place early on.
That's true. That's true. And being just happen to be at the right place at the right time, or just lucky like that. Yeah, absolutely.
Mm-hmm.
And then some people have no luck, it's like everything has happened.
Right.
I don't know. It's funny. We were going over a client plan this week, and it's like they're mid 40s and they're going to retire in like a couple of years.
Wow.
But they have no children.
Yeah, that's the key.
But I know. Like, not that I love my
Think
children.
of how sad they'd be with no family fights. And
I know. I'm sitting here going.
Their cars are probably always clean. Oh, those people.
Nobody's fighting. I know. I'm kind of jealous. No, I'm just. I love my children, obviously, but it's like sometimes the people with the most options I've seen, they haven't had children, and purposefully, like they didn't want children, and it's like they have so much more income and savings. It's interesting, but anyway, that's not the normal. No. That's not the typical American, I would say.
Correct.
So that's not really part of your financial plan. Don't get rid of the children. But they can be on a budget too, because I always like to tell parents, first of all, you don't realize how much money they cost as teenagers. You think they're expensive when they're little. Whew, just wait. And, but really we all learned our habits when we were young, like with food and money and, really, and you have to untrain those habits if you learned habits that weren't that good for you. And so you're setting the stage in doing these resolutions. So get your family involved in this, teach them about this, do it together and set goals together, even, kids, especially teenagers. So it can be like a family event.
Yeah.
Even. So they're not in the dark and they learn these things.
Some families, these more modern families, the kids know how much parents make and they know what their assets and liabilities are. And yeah, it's kind of I would say that's the norm, but they have to be, your kid has to be mature enough to, And I always like, if you have some excess, doing custodial accounts for the kids. A lot of people will start like a savings account. Well, the savings account doesn't earn anything in a bank. Yeah.
Starting a custodial account at like Charles Schwab or Fidelity, buying some mutual funds or ETFs if there's enough in there, and then putting like birthday money and Christmas money, the $50, the $100, the $25, they don't need more stuff. Kids don't need stuff. If you do that, obviously you want to have the separate, college savings. I'm not saying to avoid the college savings, but then when they're in middle school and they start learning about the stock market, you can show them their custodial account. Now, the downside is they get it at age 21 or 18, depending on the state you're in, no matter what, even if they're responsible or not.
Yeah.
But if you start teaching them about it early, and then they can actually see the fruits of the labor and, what their accounts have grown to, and they can kind of put, when they're learning about it in school or just you talking about it, when they can actually see that in the works simultaneously, what has grown for them over time, it could be very powerful. Yeah. I've seen it go both ways, where the, young adult blew the money. But I've actually seen it more times than not work in the favor of, this has been saved for me. I'm going to continue this savings now that I'm working. And it may actually give them like a down payment on a house or something so significant that they would have not had otherwise. And they didn't need all the stuff growing up. Right. You know what I mean? So I think it's very valuable. Now, a lot of parents don't know about that. You can just start a custodial account at, say, Charles Schwab, just a low cost, with no fees, and start investing even like $50, just start something so that way it's building for them over time. It just can be very powerful.
Sure.
Before we jump back into the episode, do you know if you are ready to take off and launch into retirement? Get your pre-retirement checklist, a free guide from Wiser Wealth Management. From cash flow to Social Security, we've got your countdown covered. Go to wiserinvestor.com/guides to download your free guide today. Now let's get back to the episode.
Let's get to number 9.
Reviewing insurance and estate basics.
I think insurance is kind of a sleeper. I don't think insurance agents ever call us up and say, hey, your home's up increased in value based on square footage. I think you're underinsured. Or, hey, there's a couple of things we should add to your policy to help with flooding or whatever, because they're so concerned that people are, they'll just, the premium will go up and they're just going to leave and get a quote somewhere else. So I don't know that people are, because they're not fiduciaries, they're salespeople in the end. So this is something you should be checking out. Not necessarily, are you paying, do you have the best rate?
Right.
Do you have the best quality coverage?
Yes.
That's what you're looking for.
Yes.
Most people, especially people coming to a wealth management firm, we're not looking for the general for insurance.
Right. Right.
We're looking for Chubb, Vault, Pure, to insure our $1 million plus home. We're driving nicer cars.
Yeah.
Sometimes people have classic car collections that probably are not covered properly. They should have their special insurance for that. So you need to be focused on if my house burnt down to the ground, can I build the same house back?
Yeah.
Not, oh my gosh, my premium went up $100 a month.
Right.
You have assets to protect and you have liability to protect. If there was a judgment against you for some reason, defamation, someone hurt themselves in the yard. I had a client that the daughter had a girlfriend over, I think is the story, and she had a weight or something in her hand from like their workout room, and she dropped it. She dropped it on her own toe or something. And it damaged her toe and she couldn't shear. And the parents sued the kids, the parents sued the parents that own the home.
Wow.
And the umbrella policy had to go and cover, protect that as the homeowner insurance and then eventually the umbrella policy. So you have to think about these crazy scenarios and do you have the proper coverage for that? Yeah. That's why you should be doing an insurance review.
Yeah.
And then I'll let you speak to the estate side. Either you don't have it or you might have something that isn't right.
Right.
I found one recently that their IRAs, so the IRA beneficiary is the trust, but then I reviewed the trust and the trust has no IRA provisions in it.
Yeah. So that forces it out in 5 years.
Yeah. So now the money has to get paid out over 5 years instead of 10 years.
Right.
So it's little things like that. That's why you want to have your estate documents reviewed.
Yeah. And estate, we've done Arun and I have done several shows on that. There's a lot of good shows out there. Just getting into details, and we'll do more because it is so complex. It's really, it can be complex. It doesn't have to be, but I mean, having documents in place is better than not having documents in place, making sure your beneficiaries are updated. But if you have any changes in your situation or your family or anything, definitely look then. Annually when, renewal at work, they say update, confirm your beneficiaries, just make sure everything is still accurate. Usually they have you look at it then, but don't forget about the IRAs you have elsewhere, your other 401ks from other employers. Maybe you should roll that to your new 401k or maybe an IRA. It depends on the situation. There's pros and cons to that, but just make sure that you're updating and looking at all of your beneficiaries and, making sure your wills and powers of attorney are up to date.
Yep.
And the titling of the assets as well. And if you need help with that, obviously we can, look at things with you and talk about that because it can be complex. And if you don't understand it, then definitely come to your advisor or attorney, just to make sure that, because we may, I've seen some people download documents offline and then just do it.
Right.
Not saying that's completely bad, but just because, to your point, if you have a will, and it says X, your beneficiaries may say something completely different. And then the nuances of what you just said, a lot of listeners may not know about, the trust paying out in 5 years versus and what that even means. It's just, there's a lot of nuances to titling and beneficiaries that can be complex that have taken me close to 30 years to learn. So, that's where it's just make sure that you're reviewing it. If you don't understand it, get help with it for sure.
Number 10, this is an interesting one. Schedule a money date every month.
Mm-hmm. Don't most people do that when they're looking at their bills?
Oh,
I don't know. Some people may just automate.
We have no money dates in our house.
Money dates? Yeah. I mean, I look at the bills. I just go through everything and make sure we're on track. But I don't know that it's a date or like a meeting.
Yeah, I thought it meant meeting, but I think you're right. I think it's maybe it's a money date with yourself.
But make sure everybody's in the know in the house.
Look at your bank statements and make sure everything looks legit.
Yeah,
right.
Credit cards and all of that.
Yeah.
I actually have automatic alert set up for all of my credit cards. If something gets charged to the card, like I get a text. Yeah, because we have teenagers that have the card.
Yeah,
and
that's a good idea. One month I went through my credit cards. Like, why are our credit card bills so big? Like, as I started kind of going through it, and I realized that most of it was my son.
Yeah, so it's like
and
that way.
I was like, I called him downstairs and I said, "Hey, like, I don't understand why you have so many Chick-fil-A charges. Like, you're in school." He's like, "Well, they let the seniors go get lunch." I said,
Isn't it part of your, are you paying the food plan?
I know, right? And so I'm like, you're spending more money than what like the lowest income people in America, what they make. Like this is ridiculous. And so we just created new rules. Like, you use your allowance money for that.
Yep. Well, we do that too. So we have our teenagers, they work. So I'm like, if you want extra stuff, you pay for it. If you want to charge the card, then you have to ask. Because I don't want to just see a random boop, pop up like, who's charging my card?
Right.
And the second I do it, I reinforce them like, who charged this? And so, it's like now, they know they have to ask. And sometimes they don't. They just spend their own money now. I'm like, okay. But then they have to budget because it's not endless. Exactly. So I feel like it's helping, but I'm sure they feel like I'm the money police. But, we can't just have like, no, I'm like, that's stealing if you're just taking money out of my account.
It'll disappear very fast if there's not guidelines set up for sure.
But like with anything, with any resolution that you set, with any health goal, consistency always beats intensity. So setting clear goals, being consistent with what you're doing. That's a discipline, right? So it's like consistently eating healthy, consistently spending or saving or budgeting, just being consistent. It doesn't have to be all or nothing. Right. Doing something is better than nothing, but and the more that you build on that, the better that you can be at it. Then you can just keep building on it. So you make these small changes over time that adds up to huge results, And so just being consistent is just better than intensity overall with whatever you're doing.
So let's transition to a new segment that we're doing once with everybody. And it is now Shauna's turn. 3 questions in 3 minutes. It's the same questions that we ask every team member or guest that comes on the show. Number 1, Shauna, what is a money mistake that you're weirdly glad that you made?
Well, I don't know that it's a mistake, but it's kind of a story, and it was an unintended. And so, the Taylor Swift Eras tour came around and my oldest daughter got a code for us to be able. So I sat there for 2.5 hours of my life, and I like Taylor Swift. I respect her. Mm-hmm. And I got a code, and we got 4 tickets for $1,200.
Okay.
And we were going to go, and it was in New Orleans, which New Orleans is okay. It's not my favorite place, but we were going to go. I was going to bring the 3 girls. It was going to be the 4 of us. We're going in the Eras tour. So that was like in the fall of 23 that I got those tickets. Well, a few months later, I find out that my niece is getting married the same weekend.
Oh.
And I was like, we can't go to the concert.
Oh no.
And I was like, we can't miss our niece's, wedding. Yeah. They were so upset with me because they were like, it's the Eras tour, Mom. I'm like, I know. And I did not do this intentionally, but I listed the tickets and I sold them for $12,000.
Wow.
And again, I did not buy the tickets in order to sell them.
Yeah,
we were going to go to the concert.
Right.
They were heartbroken.
$12,000.
$12,000.
Wow.
And so I had to pay capital. I had to pay gain on that. Yeah. And it was short term also because so I had to pay income. I had to pay income tax on that, which is crazy. But yeah. And I honestly wasn't doing it for the purpose of selling it at all.
Right.
But I ended up selling them and it was crazy. So, I mean, we made money off of it. So again, they're still upset that they did not go on the Eras tour. They're like, that was a once in a lifetime thing. And I'm like, I'm sorry. I apologize. But it's like, they're
going to get divorced anyway.
I hope not.
I hope not. Yes.
They've actually been together since like 9th grade in high school. Oh. It's so super cute. Actually, they've been together like 10 years or 9 years or something. And they made it through 2 separate colleges and now they've been married for a year.
But they scheduled their wedding on top of an Eras tour. What the heck?
Well, they didn't. I mean, I don't even know that they listen to Taylor Swift, right? So
if you could only travel to one place, where would you go and who would you take?
I had to think about this. I don't know. I haven't traveled a ton. I have some, but I've always wanted to go, and you're going to laugh at me. I've always wanted to go on like a health retreat where Lord. I know I really have like where it's like, I don't know, where they do like yoga and there's stuff outdoors and you eat really healthy and it's like a whole mind, body, spirit reset.
Yeah.
I've always wanted to do that. I don't know where it would be because I think they're all over, but I've always wanted to do that. I would love to take my girls, but I don't know if they'd be down with that. Maybe my mom and my sister or some girlfriends. But I've actually always wanted to do that. Like to me, that sounds really
there's been
fun.
Movies made about this. I feel like there have been.
I don't know, but I've always wanted to do that.
Interesting.
I really have, honestly.
I never heard of such a thing.
You haven't?
No.
I think maybe it's more like a spa like thing but it's like all health and
It's like a
wellness
Club Med kind of a
maybe.
thing?
Yeah, I've heard of I know like our yoga studio or one of the yoga studios I go to, they do it in other countries where they go together as a group and they do like outdoor yoga and
probably
stuff
in
like
Asia.
that.
Totally see that.
I don't know, but I've always wanted to do like a whole health retreat. So
Okay.
I don't know. I've always wanted to do that.
Shauna's bucket list. You now know. What's something you believed strongly 10 years ago that you don't believe anymore?
So I used to believe that the more that you achieved, the more confidence that you would have. And so I set out to like do all these things to prove myself and, gain confidence and all of that. I would say probably being more, I know that's not true now. Achievements, while they're great and they help, that's not everything. It's really being in alignment with yourself. Finding out who you really are and being aligned with that, what you do in your daily work, being true to myself with my health, listening and keeping promises to myself, keeping promises to yourself and actually treating yourself like somebody you love. It is like the biggest confidence builder, I would say. And it's not confidence in a boastful way. It's just being centered with yourself and just being, closer to God, closer to, I don't know, it's just being centered in yourself. So it's nothing, everything you need is already inside of you. And I didn't know that. So it's like, when you can tap into who you are and your potential, that's where alignment comes and that's where the confidence comes because you're just being yourself. So I think you do that actually very well. The way that you treat people and I think that's why I feel so aligned working with you and what we're doing is because I feel like you do that. And I don't know that a lot of people do tap into who they are and then they live every day of their life being who they actually are, no matter what room they're in. Do you know what I mean? I know we wear different faces, but it's like,
that's really deep, Shauna.
Well,
I would
you
say,
asked me about something I've learned in 10 years.
I would say that I'm very simple. And so it comes down to, I don't know how to be anybody else other than me. So it's sometimes the situation, as my kids say, it's like, what did my daughter say recently? She says, Dad, I don't know if you should be at this event. And I was like, why? What's wrong? Well, I'm just kind of being dad, just kind of bugging her, and she's like, well, you just say everything you think.
Is that just because you're in your late 40s, like mid 40s? Like
I'm
now
it's
like,
old.
No, that's not old. That's just coming into your own where you're like, you don't care what people think about. Like you don't hold back.
I'm just saying, I have so many stories with that. I remember coaching my son's basketball team. Now this was not like, these were like 11-year-olds. But I have to win. Like I have to find a way to win. And so we were undefeated the first season. And then we only have one practice a week. And then you have the game. Like it's not that right. It's not that intense. It's not intense. It's not travel ball. But
it's a volunteer dad coach.
It was like done through the church, and you see where this is going. And then the clock doesn't stop. Like it just runs.
But you're treating it like the NBA with 11-year-olds.
Everything I do is going to be 100%. Like you don't do anything half-assed. Like you do 100%. Of course not.
Why would you? Why do it then?
So yeah, I remember. I remember there was this really bad call, and one of our best players was like fouled out or something in the game, and I said something that was kind of ugly directly to the ref, like right in his face.
The Christian ref from the church.
And the other coach walks over. He's like, "You can't say that. This is a church." And I looked at him. I said, "I'm the same person outside this building as I am inside this building." And he didn't know what to say to that. But yes, that's me. It's just me. It's simple.
See, maybe you turn when it becomes competitive, right?
No, I don't turn. I just am competitive. Yeah. That's why my family won't play me Monopoly. It's like, No, we're not playing Monopoly with Dad. He's ruthless.
He's ruthless. He makes everybody poor, and he takes all the rents and all the hotels.
That's right. I
yeah.
thought it'd be a little like this past Thanksgiving, I thought it'd be a little different because we played Elf Monopoly.
Oh,
thinking,
is that fun?
Well, it's like, it's confusing because you're like, I don't know what's important in Elf World, but it's from the movie theme Elf, right?
Yeah.
But yeah, no. After I figured it all out, I was like, oh, this is just like real Monopoly.
Of course it is.
Won every single game. Took me hours, but
We did the whole Family Feud thing.
Oh.
There was like people just sitting around, and we had the host, and it was hilarious. It was hilarious. It was silly.
All right. Well, these are your questions, not my questions. Those are good answers. Thank you.
Yeah.
So really, guys, go make it a good year. Just be intentional, set goals. We do that as a company. We set goals. We achieve goals. We set goals really, really high. We don't always achieve the very highest goal, and that's okay. Because if you fall short of the highest goal, you're still better than everyone else.
Yeah.
And so just don't live life just by chance. Just set goals, make a difference.
Consistency.
Very consistent. And sometimes you have to you have to not let things happen to you. You have to go make things happen. I think that's probably the best advice for this new 2026 years. Go make things happen. Don't be the victim.
Yep.
Victims never win.
No.
Right?
No.
Go be the hero or go be someone else's guide, but don't play the victim card. Well, let's make it a great 2026. Thank you for listening to today's episode. If you're interested in learning more about Wiser Wealth Management, want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click the link in the episode notes. See you guys next week.